everybody. Welcome to today's edition of the 1Mby1M podcast. Today, I'm speaking with SC Moatti of Moatti Capital. SC, welcome to the show.
Thank you so much for having me. Great to be here.
So, SC, let's start by introducing our audience to yourself, as well as talk a bit about Moatti Capital. How big is the fund? What kinds of investments do you like to make? What check sizes do you like to write, and so forth? Let's get to know one another.
Absolutely. So I'm the founder and managing partner of Moatti Capital. The fund is myself plus my two partners. And where we invest and how we invest, we write a small check size at a later stage, which means it's typically under $1 million, but at a series A at the earliest, and then B and C. The reason we're in the lucky position to invest at later stage is that we give our portfolio companies a very, very unique and very important value add, which is access to hundreds of thousands of early adopters and product managers through my organization, Products That Count. And different companies in the portfolio use that access differently. Some use them to sell their product and services, so for customer generation, revenue acceleration purpose. Some use them for business partnership, so scaling, and then some use them for hiring, so really as they're growing their organization, accelerating either the path to revenue or the path to scale.
I see. Very interesting. Can we talk a little bit of the specifics, and then we're going to go to some portfolio companies and going through some case studies to understand how people are using your platform. So what about geography? Where do you like to invest?
We invest on the West Coast of the United States.
And what about industry sectors?
Yes, we invest in what I call the third wave of connected technology. So one thing to know about me is I'm an expert in that field. I wrote a best-selling book on this, and I spent 12 years building product and companies in the field of mobility and connected technology. After I sold my last company, I spent a few years at Facebook. Anyway, so we are where I think in what I call the third wave of connected technology. The first wave being put a phone in every hand, so the Nokia era where I spent a few years. The second wave being collect data about everything and everyone, which is a lot about what Facebook was about. And then the third wave is now that you have a phone and data in everybody's on everybody, do something useful, and so disrupt the enterprise and disrupt healthcare. And as you do that, some of the infrastructure is going to need to be enhanced as you know, to meet the needs of enterprises and healthcare organizations. So these are the segments, the industry segments we invest in as part of that third wave of connected technology.
And is it all B2B?
Some of it is B2B, some of it is B2C. Right now, I am not seeing a lot of opportunities in B2C simply because the platforms that enable disruption of consumer offerings isn't quite there, right? If you look at what are the upcoming platforms, there's the blockchain platform, which is a little bit, too early for prime time. There's the genomics platform, which is a very interesting area, but not quite yet consumer ready. And then there are a few other platforms around, robotics and such, like which people call IoT sometimes, which isn't necessarily yet ready for software innovation. It's more of a hardware play at this point, which means that it's more in the hands of the big companies.
So when you say you have 100,000 early adopters, there must be a correlation with what kinds of companies you like to invest in and this community that you've built. What is the composition of that community?
Yes, absolutely. So those early adopters are product managers, growth managers, marketing managers, and who they are generally tech professionals working for companies across many different industries, of course technology, but also they work in the innovation divisions of very large conglomerates and companies. And those people are basically early adopters for themselves, so of course they'll test the latest stuff, but mostly and most importantly for their organization. So they are the ones who are bringing the new tools, the new technology, the new services inside their organization. And they do that across the United States and across pretty much all verticals. It used to be that we were mostly in the tech industry, but now about 20% of our audience is life science audience, 20% is like fintech audience. So it's across industries now.
Interesting. And what is how does this audience stay engaged with you? When you say you have this other platform that is kind of like adjacent to your fund activities, what is that a community? Is that a newsletter? How are you engaging with these people?
Yeah, absolutely. So if you go to our website, www.productsthatcount.com, you'll see that we have a number of online programs. We have videos, podcasts, blog articles, and our website gets several hundreds of thousands of unique visitors every month. And then we have a number of offline programs in the major tech hubs. And so every month in every city where we have a presence, we get anywhere from 100 to 300 people who get together to learn from a C-level person, to network, and basically to talk about what it takes to build a great product.
Okay, got it. I understand the model. So let's do some case studies. Tell us about your portfolio. What have you invested in, and how have you helped the portfolio companies get to market?
Yeah, absolutely. So I'll take one of our recent investments. The company is called Amplitude. It's an awesome company with an awesome team. What they do is they are a cross-platform analytics provider. So they go after Omniture or Mixpanel. And a few things I love about this company. Well, first of all, this is a great underdog success story. When they started, they were, a small player. There was a big dog in the mix, and through incredible execution and a great team and a great product, they basically took over the top spot in one vertical, and now they're expanding.
Can you describe the business so we can follow along what's happening really?
It's an analytics company. As I said, they go after what Omniture provides or what Mixpanel provides.
Horizontal? Completely horizontal?
It is horizontal, correct. Their customers are Mozilla, Intuit, Walmart, so across all verticals. They go across, websites and mobile and basically any platform, and they track everything that happens on your website or inside your mobile app, and they give you stats about user behavior and user engagement.
And what is the winning value proposition that helps them win against the Omnitures of the world?
Well, first of all, they have a very solid product that's easy to use. Second, they are cross-platform, by design, and so they provide that visibility by design. And then third, they focus on actual, like, customer-focused metrics like engagement, as opposed to vanity metrics like number of clicks, which honestly a click doesn't mean anything. So they are looking at really what users are doing, what kind of behavior they're showing when they're using the service, how you can drive them to be more engaged, as opposed to how many clicks a page got.
Mm-hmm. And they came to you at what point, and what did you do for them?
Yes, so they have been part of the Products That Count network for a number of years. I've known the founder for a long time. He benefited a lot from being a part of the Products That Count network. He hired some people from it. He got some business out of it. We helped him raise his brand. And when he raised his last round, he came to us and said, Products That Count is an organization that we feel very close to. We've benefited a lot from it. We consider it a strategic partner. We'd like you guys to be on the cap table.
Mm-hmm.
So after we made the investment, the value that we've been bringing to them over time, we basically regularly sit down with the executive team, the go-to-market organization, the CMO, the chief product officer, and review their plan and their goals. And item by item, we help them out. So, for example, they have a target account list, and we help them by making introductions. They have a very aggressive enterprise sales strategy. So we give them access to our executive audience, which we get together on a frequent basis via invite-only salon and executive events and such. They have a very specific messaging that they're trying to convey to their audience. And so we help them by promoting this messaging and sometimes even testing their messaging on our blog, in our newsletter, and so on and so forth.
Got it. So is this the traditional way that you get involved in a company, where you have people in your community who then go out and raise funding and bring you into the cap table, or are VCs also bringing you into the cap table? Where does the relationship begin?
Yeah, so the example of Amplitude, we were brought in by the entrepreneur. That's about half of the way we get brought into deals. And entrepreneurs who see the value of Products That Count tend to come to us because they know what we can deliver, and so that's about half of our investments. And then the other half of our investments is the investors of those entrepreneurs who see the value and then come to us and invite us to be part of their syndicate.
Okay. And what is the size of your involvement in these cases that you're talking about?
We're a minority investor, so we're part of a syndicate. We generally don't lead a round.
How much do you put in? What is the check size, average check size?
Yeah, it's typically under $1 million.
And what, is it $250,000, $50,000? What's under $1 million?
Yeah, so depending on the opportunity, it ranges from a few hundreds of thousands of dollars to about $1 million. So in the last, if I look at our last 3 investments, we've written checks 500 to 1.2 million.
Okay, all right. And are there other examples that are worth discussing that illustrate other aspects of your value proposition?
Well, I think that's a good one. Because Amplitude is really getting value out of access to Products That Count for the purpose of selling. Some of our other portfolio companies have used us for the purpose of hiring and scaling their teams, which we've enabled as well. But it's a similar model where they'll say there's great value here to have access to this audience. And then the purpose of the access varies from, like I said, selling, business development, or hiring.
Okay. And which funds do you co-invest with?
One thing to clarify to your point is we are not interested in getting involved in companies where we're not adding very tangible value. It's really important for us to be smart money, to be money that adds a lot more value than the size of the check.
Yeah, okay. And what VCs do you co-invest with? What VCs are familiar with your value proposition, and whether you're bringing them in or they're bringing you in, or the companies are bringing them in, where are your collaborators?
Yeah, so lots of them. If I look at the last few investments, I mentioned Amplitude. We co-invested with Benchmark and Battery and IVP. Another of our recent investment, Fabric Genomics, we co-invested with Matrix Partners and Roche as a strategic investor. We have a number of firms that we're very friendly with and have invested with in the past, like Mayfield and Menlo and Glen Capital and Aligned Venture Partners and Floodgate. Those are all kind of friends to the fund.
Okay. All right. So now, when you look at the opportunities, besides adding value, are there specific investment thesis as regards to, are you looking for unicorns, as in billion-dollar plus TAMs, or are you looking for companies that are, that have mid-sized TAMs and would be looking at, capital efficient execution and early exits? What is your investment thesis from a scale point of view?
Yeah. So let me give some perspective on this. There's definitely, I want to say there are three segments of investors out there, and I'll call them the whales and the dolphins and the minnows, which some of your listeners may be familiar with those naming conventions because they come from the gaming and social industry. So I'll draw that parallel to kind of tell you what we're looking for. So a whale in the gaming industry is somebody who buys all your shiny armors and your purple swords and all that. And so you have very few of those, and when you find one, you do whatever they ask you to do. Well, a whale in the world of investing is exactly the same. So if you're going to get a whale on your cap table and you're going to take an investment from them, basically you're going to do whatever they tell you to do, and that check better be really, really big. Now, on the other hand, if you're going to take a huge check, you need to know how you're going to spend it, because otherwise your company isn't going to go anywhere. And that's a lot of the cases of, current sort of zombie unicorns, which is a lot of right now. So we don't play in that category. We're not interested in playing that game. This is sort of what happens right now, like to play like the game in that segment, if you want, is what SoftBank is doing or what Sequoia is doing, and we're not playing in that category. The second category of dolphins is, if you think about it in the terms of gaming, they're the people who tell you totally should play Candy Crush, this is really cool, like they're your social butterflies. Well, we like to think of Mighty Capital as a dolphin where, our portfolio company success is our success. So, when you're an entrepreneur and you're looking for investors, I think you should be looking for dolphins, because they will add something unique to your company and they will care a whole lot about making your company successful, right? So you want to think about like what kind of access do they have, what kind of ecosystem can they accelerate for you, and you want to think about like how do I swim with the dolphin, how do I like leverage them to make myself more successful. And so in the case of Mighty Capital, swimming with us, right, you get access to that incredibly large community of people, and then you can leverage that for, selling, hiring, testing, and so on. And then the third category of investors, which we're not part of, is the minnows. And the minnows, are all the lurkers on Facebook and, like 99% of your population. So they're excited to be there, but they're incredibly passive and they don't add a ton of value, right? So you will as an entrepreneur, need to get some of those on your cap table, but you also need to be aware that their value is limited and they can be a great time sink. And so you want to...
Why do you want to get them on the cap table? I mean, let me push back on that, because you don't want those guys on your cap table.
Yeah, well, sometimes you need them because they will help you early on. They will help you get started. And
no, then they don't fall in the minnow category. They fall in dolphin category, using your terminology. As long as they're passive. If they're passive investors, then you don't want them. But if they add value, they're not passive investors. They're actually doing something for you.
Yeah,
and that's certainly what you want.
Yeah, you have a good point here. But sometimes, to get things started, you will need to have some of those on your cap table. It's just a reality, right? So you may not want them, just like you may not want to do the grind every day, but then there is reality, and sometimes you need to make some compromises, and so what I'm saying is they will end up on your cap table, and this is how you want to effectively manage them, as in, like, you want to keep them entertained, but you know that they're not going to add a ton of value to you.
Yeah. So I think the reality is that when you have limited, as an entrepreneur, when you have limited choices, then those kinds of investors may end up on your cap table just because you don't have the power to get to whom you necessarily want to get to. But as you develop validation of your concepts, and if your customers start to engage with you, and your value proposition starts to get validated, that's when you start to gain bargaining power, and then you shouldn't be having those kinds of people on your cap table. You should go for the people who will add value.
Well, and you say bargaining power. I don't think of it this way. Like, we're dolphins, so we're not in a power struggle mindset. We work with our entrepreneurs. I would rephrase that and say this is more like as you start to gain traction, right? And revenue is the best way to fund and grow your company.
Well, I think we have in our community, we use a terminology, or not terminology so much, a saying, a mantra, that do not go to VCs as beggars, go as kings.
Correct.
So the problem is there's a lot of people who are just randomly chasing VCs all the time. They probably go have 50 meetings, get rejected by all 50, just because they don't have the goods to raise around with. Instead, if they spend that energy chasing customers, they would make a lot more progress, a lot more headway, and everything would go in the right direction. But there is this problem in the ecosystem where entrepreneurs believe that the one fine morning they wake up and decide to become an entrepreneur, the first thing they need to do is go chase VCs. It's a rampant problem, actually.
So I would agree that the best way to go to a venture capitalist is as kings. I like that expression. I'll maybe to help your audience, I'll share a very important distinction. As an entrepreneur, your job is to say yes, right? Yes, we'll deliver on time. Well, yes, we'll take on that contract. Yes, we'll hire like another person to help, and so on and so forth. So it's a job of saying yes. And as an investor, your job is a job of saying no. So like you said, right, I get entrepreneurs often come to me and they will have this narrative. They'll say, it's been really challenging lately because we've had a lot of attrition on the team and our product isn't selling as much as it should, and we really need to get like a few $1 million in so that we can get past that. Well, you just given me 5 reasons not to invest, right?
Yeah.
So those
kinds of narratives never sell with investors.
That's right. Versus if someone comes to me and says, "Oh my God, we have so many contracts, and we are experiencing so much growth. Everybody wants to be on the team. I just don't have enough money to hire people so that they can go ahead and deliver on our customer commitments." Well, then I'm all of a sudden starting to think, well, wait a minute, that train is leaving the station. I better get on it or I'm off.
That's exactly right. So the corollary of our previous saying is that VCs love to come to the rescue of victory. And that is also a very popular saying in our community.
So it's a very interesting point that you mentioned, because what you're saying is sort of the traditional VC industry whales and minnows, right, is a little bit broken. Some people are just here for the show, and some people are sort of, coming in and taking over a victory, as you say. And I would say that I tend to agree. The traditional industry is, has its fault. The reason I talk about the Dolphins is that this is something that, we at our own scale are trying to change. And there are other Dolphins out there who are saying we want to do things differently. In fact, we want to go back to the origins of venture capital, where the origins was you have somebody who's highly connected, highly experienced, highly valuable, who is helping a young entrepreneur, and there's a whole system of apprenticeship, and this is a very, very core value to Mighty Capital.
Yes. Where the next question that comes in, though, is the metrics of investment. So, for example, you have said that you like to invest in Series A and beyond. Well, to get to Series A these days, Series A has moved upstream, right? So, actually moved downstream. So you may have to raise 5 rounds of capital before you even qualify for Series A. So let's say in SaaS, the SaaS metric these days across the board is $1 million ARR. Getting to $1 million ARR is not that easy, right? So an entrepreneur has to either bootstrap to 1 million ARR or has to raise a pre-seed, a seed, a post-seed, a pre-Series A before they get to 1 million ARR. So there's this whole, early stage game that is very complex.
Well, let's break it down a little bit, because it's not that complex. It's sort of back to your point about focusing your energy on making revenue as opposed to raising money. And I encourage every entrepreneur I talk to consider, especially in SaaS businesses where it is really all about the revenue traction. So I encourage entrepreneurs to focus on that first, and then raise money. And let me sort of give a different perspective on that. Let's say you have an idea, and you decide that rather than build a prototype yourself, maybe teaching yourself how to code and maybe investing a little bit of your savings, and being capital efficient and very scrappy and very frugal. Let's say that you go to an incubator, and the incubator is going to help you package your idea so that you can go and sell it to a few customers, and along the way they'll take like 7 or 10% of your company. And so once you've done that, you go and you try and sell your company, but you find out that the best way to do that is to go to join an accelerator program. And the accelerator program is going to help you go from like 1 to 10 customers so that you're ready to raise your pre-seed or your seed round. And along the way, they'll take 10 to 20% of your company. And then you graduate from that accelerator and you're ready to raise a seed round to get you to staff up your team a little bit and build a replicable model. And they'll take anywhere from like 20 to 30% of your company. By then, first of all, you have already lost control of your company, and pretty much any professional Series A investor will stay away from your company. And you're going to wonder why. Well, you have left in your company, like say about 30% ownership. And a Series A investor will take another 20% of that. And now you have 10% left. And what's in it for you? And you may think, oh, I want to change the world. I'm not here to make money. But on a day-to-day basis, like, why would you put in so much work if you're not going to get anything out of it? And that's why an investor would stay away from a company that has that kind of cap table. So the moral of the story, if you want, the lesson learned is that when you're at the very early stage, you want to be incredibly capital efficient, and you want to find ways to raise as little capital as possible and make as much revenue as quickly as possible.
So you are preaching to the choir. I'll let you tell that whole pitch, because it's exactly our philosophy. We have a very clear philosophy of bootstrap first, raise money later. We don't take any equity. We are the largest accelerator out there, most likely, certainly the largest virtual accelerator in terms of the number of companies we work with. And we don't take any equity, because I don't believe you should be taking equity as an incubator or an accelerator, especially not those kinds of equity. If you are an accelerator fund, like a Y Combinator or Techstars, they're putting in 100, 200K, 100, 120K for 5 to 7% of equity, and they do have great ecosystems, so that's different. But the vast majority of accelerators actually don't add much value, and they take away a lot of equity, and exactly the scenario that you described happens. So our preference and our advice to our portfolio of companies is that do not try to raise money. Do not try to go through these, drip drab financing, 50,000 here, 25,000 there kinds of, and each round you lose control of the company. Try to build your company on customer money and go straight to a significant round of financing when you have validation, when you know that you are going to be able to build a high velocity large company. If you don't get there, but you are getting, you're getting customer money, you're making progress, just bootstrap a business. There are many more $1 million, $5 million, $20 million ideas out there than $1 billion, $2 billion ideas. So build a small bootstrap company, and that's fine too. That's also, we consider success. But this, losing your company by doing 7 rounds of financing and having 5% left for yourself, this is not the way to build a company.
Yeah, I totally agree with you, and any professional VC will agree with you, because there has to be something in it for everyone, not just the venture capitalists, but also the entrepreneurs and vice versa.
Let me make one point. The reason I said it's very complex and you said it's not complex at all, I think it's very complex, because for a first-time entrepreneur encountering all this complexity, they don't have the knowledge to make these decisions without help. They make very bad decisions. I mean, we often see companies that have already given up 50% of their company, and they're only at, barely at seed. They don't have enough goods to even raise any reasonable round of financing, and they haven't achieved very much, but 50% company is already sold off.
Yeah. So one maybe additional point on this that we observe sort of on the exit side. We often hear companies tell us, "Oh, I will not settle for a small exit," and I want to challenge that for your audience and help them sort of see things in a slightly different light. Every time I speak to a room of entrepreneur, I ask the question. I say, well, you have a small company, and someone comes to you and they want to buy your company for $15 million. And then there's always one person in the room who has this reaction, like, oh my God, you just insulted me. 15 million, I'm going IPO or nothing. I'm going to challenge that view and say $15 million can change your life, and for most people, it changes their lives, right? If you're into cars, you can buy 5 Ferraris. If you want to start another business, you can entirely fund it, and so on and so forth. So one thing that I tell entrepreneurs all the time is that if you're going to be an entrepreneur, you don't have just one idea in you. And if you're a first-time entrepreneur and you're offered an opportunity to land your plane at a $10 or $15 million exit, do it, because your next company will come. There will be a next company, and think about like how differently you're going to start that next company. What different position you'll be in when you can say, I'm a serial entrepreneur. I sold my company for $15 million. I'm self-funding the next one, and so on and so forth.
Completely agreed. This is also very much part of our core philosophy. Excess is not a requirement for success is something that we talk about. We talk about these. We have a lot of case studies where an entrepreneur did a first company, did a small exit, bootstrapped the second company, and then did a much bigger company with that. So everything that you've said, I agree with. We constantly push these, early exit scenarios as well. If you have a smaller idea, smaller TAM venture, there actually are some small funds, small micro VC funds that are starting to acknowledge this opportunity of, the fact that the vast majority of acquisitions in our industry happens at the sub 50 million price range. Anything beyond that is a very low probability event. So, if you are working in the tech industry, you should be reasonably comfortable with probability. Do you want to play a very low probability game, or do you want to, you can say you want to play this very low probability game, go big or go home. I think it's complete nonsense. I think you should play, if you have an idea that is very big and that is very high velocity and it's ready to go right away, you have a rocket, fine, that's a different trajectory. But the vast majority of companies do not have that trajectory. Hypergrowth is not a natural state, and therefore you should be thinking more in terms of how to do a capital efficient business, get customers, get product market fit, and find an early exit so that you have, everybody makes money off the deal instead of stuffing up the cap table with lots of capital and then ending up as a zombie. Nobody wants to acquire you at the valuation that you want.
Right.
So we are completely in agreement philosophically, and we must try to do some business together.
Absolutely.
All right. Well, great. It was a wonderful conversation. Audience, thank you for listening. And as you know, you can go to the website 1Mby1M.com and find the free public roundtables tab and register to come and pitch or attend any of the mentoring sessions, and we'll be happy to work with you on your business. And we'll be back soon with another edition of the 1M by 1M podcast. Thank you for listening.